Most investors think they are trying to predict the market. They're not. They're trying to anticipate the behavior of other participants. Markets are not physics problems. They are strategic interaction systems. And that means markets are games, not in the sense of gambling, but in the sense defined by game theory, multiple agents, incomplete information, strategic decisions, feedback loops, and constantly shifting equilibria. Game theory began formally with John von Neumann and Oscar Morgenstern in the 1940s, later expanded by John Nash. The core insight: your optimal decision depends on what others are likely to do and what they believe you will do. This recursive logic defines financial markets. Let's start simple. Imagine a stock trading at $100. You believe it is worth $120. First order thinking says buy. But what matters is not what you believe. It is what the marginal buyer believes and what the marginal seller believes. Price moves when expectations change, not when reality exists. Markets are expectation aggregation mechanisms. You are not trading assets, you're trading beliefs. Consider earnings season. Company beats expectations. The stock falls. Why? Because expectations were higher than reported results. Game theory tells us that outcomes are relative to expectations embedded in price. It is not about absolute truth. It is about consensus equilibrium. Now let's introduce strategic behavior. If enough participants believe central banks will cut rates, they front-run that belief. Prices rise before the cut. When the cut happens, there may be no buyers left. Price falls, the event was anticipated, the move was exhausted. This is forward induction. Participants act based on anticipated reactions. Markets are anticipatory systems. Game theory also explains bubbles. If you believe others will continue buying, it may be rational to buy, even if you think valuation is extreme. This is Keynes's beauty contest analogy. You are not picking the face you find most beautiful. You are picking the face others will find beautiful. Markets often reward coordination, not truth. And coordination can persist longer than fundamentals justify. Let's talk about equilibrium. In game theory, equilibrium occurs when no participant has incentive to change strategy given others' strategies. Markets constantly search for equilibrium, but equilibrium is temporary because new information shifts incentives and incentives shift positioning. Positioning shifts price. Price shifts incentive again. This creates dynamic, unstable equilibrium. Markets are never static. Another critical concept is asymmetric information. Not all participants have the same data. Institutional investors, hedge funds, retail traders, central banks, corporate insiders. Each operates with different constraints and information sets. This creates strategic advantage for some players. But advantage is rarely permanent, because once discovered, it is arbitraged away. Game theory predicts edge decay in competitive systems. Now let's discuss zero sum versus positive sum. Markets overall are positive sum long-term due to economic growth, but short-term trading is often zero sum before costs. For one trader to outperform, another must underperform. This creates adversarial dynamics. If you're making money consistently in short-term trading, ask, who's on the other side? Why are they wrong? Are they uninformed? Or are you missing something? In competitive environments, sustained edge requires structural advantage, not opinion. Another important concept, signaling. Participants send signals through behavior, large option positioning, unusual volume, insider buying, policy language. Markets interpret signals and adjust expectations, but signals can be deceptive. Central banks sometimes use forward guidance strategically. Companies manage earnings expectations. Participants attempt to influence belief formation. This is not passive price discovery, it is strategic communication. Now let's talk about coordination risk. When many participants adopt the same strategy, passive indexing, volatility selling, momentum, they implicitly coordinate. Coordination increases efficiency during calm, but increases fragility during stress, because if all players attempt to exit simultaneously, liquidity collapses. Game theory shows that coordination without diversification increases systemic risk. This is why crowded trades unwind violently. Everyone shares similar payoff structure, and when incentive shifts, equilibrium collapses. Consider bank runs. If depositors believe others will withdraw funds, it is rational to withdraw first. Even if the bank is solvent, belief changes behavior, behavior changes outcome. Outcome validates belief. That is, reflexive game theory in action. Financial markets behave similarly during liquidity crises. Now let's connect this to personal investing. When evaluating an opportunity, ask, who is on the other side? What do they believe? What incentive do they have? Are they forced sellers? Are they liquidity constrained? Are they managing quarterly performance? Are they passive allocators? Understanding incentive structure gives strategic clarity because markets move when incentives shift, not when narratives shift. Game theory also explains volatility spikes. If traders believe others will de-risk, they de-risk first. That accelerates volatility. Volatility increases margin requirements. Margin requirements force selling. Selling increases volatility. Feedback loop. This is strategic contagion. There's also the concept of payoff dominance versus risk dominance. In coordination games, sometimes the optimal equilibrium is not the safest. Participants choose the safer equilibrium if uncertainty is high. Markets often choose risk-dominant equilibria during stress. Capital preservation over profit maximization. Understanding this explains why markets overshoot during crisis. The uncomfortable truth: you are not competing against reality, you are competing against expectation structures and strategic incentives. If you ignore that, you are thinking in isolation, and markets are never isolated. So how do you apply game theory? Think in terms of incentives, not opinions. Identify crowded positioning, anticipate second-order reactions, respect equilibrium shifts, avoid assuming static behavior. Markets are adaptive games. Static thinking fails. If you remember 3 things from this video: first, markets are strategic interaction systems. Second, price reflects expectation equilibrium, not truth. Third, edge comes from understanding incentives and positioning, not from predicting headlines. In markets, intelligence alone is insufficient. Strategic awareness determines survival.